All right. Well, good morning, everyone. Thank you for attending the Place Your Trades Network Spaces to discuss North American oil and gas. This Spaces is brought to you by Tradeovate, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can trade these on the DOM on Tradeovate's main platform as well. It's a great way to get exposure to the futures markets with defined risk. You can use the link in my Twitter stream to go and get the Tradeovate app for free. I also write a weekly blog on markets that you can find at placeyourtrades.com. Just click on chigrl's blog, sign up, it's free. All right, now on with the show. We'll start by introducing our guests. First, we have Abhi Rajandram, which I never pronounced that right, who's the director of energy, director at Energy Intelligence Research. He's responsible for identifying and analyzing key trends ranging from upstream to downstream refining petrochemicals. Subsectors, as well as other areas tied to North American energy, corporate and financial analysis, oil field services, and LNG. Prior to joining Energy Intelligence, Abhi spent 2 years as an investor in the following sectors: energy, renewables, refining, and chemicals. Abhi also spent 7 years as a sell-side equity research analyst, including 5 at Credit Suisse, where he was the lead analyst for MLP infrastructure and LNG sectors, and also covered the chemical sector. He's also an adjunct scholar at Columbia University Energy. Next, we have Alex Lindsay, better known as Albertagarbage. He is an oil patch renaissance man. He's an engineer who has worked in every oil and gas play in Western Canada and founder of private junior exploration company Resolute Resources. Resolute Resources is a Canadian energy company engaged in the exploration and development of crude oil from shallow Cretaceous sandstone reservoirs in northeast British Columbia and northwest Alberta, utilizing multilateral drilling technology. And finally, last but not least, we have Jason Pollard. He specializes in oil due diligence at Altoga Research. Altoga Research is recognized as a leader in oil and gas research in Texas. They have a deep understanding of the industry and have developed a reputation for locating hard-to-find completion documents, well logs, well files, maps, and other critical information, as well as generating profitable drilling prospects, providing comprehensive environmental field audits, and simplifying Texas RRC regulatory filing services. He is currently overseeing operations on a restructure in the oil and gas industry. So welcome, everybody, now that that is out of the way. I'm going to start with Abhi because he actually has to cut out a little bit early today, around 11:40. So I just want to make sure that we get questions in for him. So, Abhi, so obviously we've seen a large sell-off recently, but overall, well, it's kind of a two-part question. Overall, what are the fundamentals looking like, particularly in the United States? What are the contributing macro factors? And if there's a tightening of credit and economic activity, could it be that OPEC tightening may not be enough? That's kind of a three-part question, but I'll let you take it. Go ahead.
Sure. Thanks for having me, Tracy, and looking forward to the conversation. Yeah, I mean, I would just say, a couple of things, which are one, I think fundamentals are okay. They're actually fine. I think the market has, if the oil market has started to get better over the last month or two than it was kind of in the early part of the year, and at the end of last year. I think we've started to see signs of demand picking up. And this is happening. We're now only on like May 3rd. This is happening, right when the OPEC cuts are just starting to kick in. So in the next month, from a fundamental standpoint, I still expect to see demand continue to pick up, and and that supply restraint also take hold. So I think fundamentals are okay. I mean, I think I think they're not perfect, they're not great. There are some parts of it that are still sloppy and iffy. I would look kind of more to the downstream markets, especially on the kind of the diesel jet parts of the crack, where I think it's again, even there, I think it's I think you could argue that it's in part from some demand questions and concerns, but also certainly in part from just kind of increasing refining capacity and utilization, adding to some of the sloppiness there. So I think fundamentals are okay, but of course the market obviously doesn't trade purely on fundamentals all the time. And I think just like we saw. Not that long ago, before the OPEC cuts in like kind of mid-March, with the whole Silicon Valley Bank situation, that we're kind of back to a rise in kind of major concerns around banking, around the financial sector, around what's ahead over the next month or two, with the Fed likely to raise rates again today, debt ceiling standoff. I would say also kind of worsening economic data, especially here in the U.S., also kind of weighing on markets. So the move in oil prices is really not that surprising, given the kind of the macro risks are increasing. And so I think we're just going to be in a period here where kind of macro and sentiment is going to sort of trump fundamentals for now. And in the next month, I think fundamentals should continue to improve, provide some kind of support and floor, but again, macro still kind of run the show, at least for the short term.
And then we've seen, I mean, markets are holding up pretty well, in general, surprisingly. But, and we just had the U.S. oil majors and refiners just have been reporting, and they're blowing it out of the water, but we're seeing equities sell off, or we're seeing oil and gas equities sell off. Is this solely due to oil prices falling? I mean, what are your thoughts on that while the rest of the market is holding up?
Yeah, I mean, we've definitely had this weird market, right, where risks are growing, the overall market is holding up. Again, kind of led by a small group of companies, including or led by again the big tech companies once again, and we've had kind of this rotation and this kind of this this risk off sort of environment setting in, and I think that's impacted oil, it's impacted other commodities, it's impacted I think kind of key commodities I look at, like copper, and I think oil equities. By the way, gas prices have been pretty weak for a while, and that's also kind of factoring into numbers that some companies are dealing with. The refining crack is certainly kind of faded to some degree over the last couple of months. I think all of this is kind of contributing. I think it's just kind of a sort of a resetting of expectations, right? There was an expectation that we were going to be kind of into this tightening market, in 2Q and into the summer. We're kind of going the other way. I think that's driven that. But again, I mean, I think many of these markets across the energy complex in particular, should find a floor at some point. Where that floor is, I think, is unfortunately going to be driven by macro as well, not just fundamentals over the short term.
Yeah, absolutely. And then I wanted to touch on a little bit on, since Venezuela and Chevron deal. Basically, Chevron, we're importing again from Venezuela, because Venezuela owes Chevron money. But Chevron has recently said that they want to increase production there. I'm not sure how feasible that is, and import more from Venezuela. Do you think this is going to eat into imports from Canada at all and affect Canadian oil prices? If there is any kind of meaningful increase at all?
Yeah, it's a good question. I mean, I think Chevron obviously kind of sees this potential for kind of a 50% jump in their production, and I mean it's interesting because Venezuela is kind of one of the more prolific oil resources out there, right? And obviously has been neglected, underinvested in, starved for a long time. If Chevron can kind of give the right amount of investment and capex and really help to that resource, they can probably kind of squeeze it to a decent degree. Now I think the supply increase from there is still likely going to be kind of at the most maybe a couple 100,000 barrels a day over the next, and it's going to take time over the next year or two is how I'm thinking about it. Um, but to your point, I mean, I think the market will sort of have to adjust for making room for those barrels. I don't think it's going to be a hugely material amount of displacement for Canada. I think it's probably more likely a displacement of imports from other sources overseas. So that's kind of how I would think about it. But one other point I wanted to make, which we didn't kind of touch on earlier, is I think part of the reason for fundamentals and the market, kind of having a hard time, lifting off this year, right, despite the OPEC cuts and whatnot, is that supply has been pretty, pretty resilient. The Russian exports in particular, even though they claim to have some cuts in March, the export market has remained pretty firm. You've had pretty robust supply from places like Iran and some of these other sources. So back to your question, Venezuela kind of adding some volume, which is not going to be a whole lot over the next year or two, kind of helps to fill some of those gaps, right? And we'll kind of see how, to what extent OPEC cuts over the next couple of months. With weaker prices, they're likely to cut closer to what the plans are to kind of help stabilize prices. But that's just in the process of playing out.
All right. Well, thank you. We will get back to you, Avi. Now, moving kind of from the macro picture, we're going to head over to Canada, and let's talk to Alex for a little bit here about what's going on in Canada oil patch. So let's talk about Suncor a little bit. Obviously, there's been a recent shakeup with Rich Kruger coming in as CEO. So what does this mean for Suncor?
So thanks, Tracy. So Suncor, for those who are not familiar or don't follow me, I've spent several years just mercilessly wailing on Suncor because of their relative underperformance to other, large Canadian oil sands E&Ps. And to look at why that is, you have to understand a bit about Suncor as an organization. I've spent some time working there, so I at least have a picture. And Suncor was this like really bureaucratic, inefficient, the ultimate question of anybody who worked at Suncor is, who do you know? How do you work here? Because you have to know someone. And so, of course, they underperformed. They had all these operational issues. They had all these safety issues. And their CEO, the previous CEO, Mark Little, seemed powerless to do anything about it. And so Mark Little is out, and Rich Kruger is in. So who's Rich Kruger? Rich Kruger was the CEO at Imperial. He is an ExxonMobil guy. It appeared that he had been being groomed to be the CEO of ExxonMobil, but then he got divorced and started showing up at business meetings with hookers, and that was just too much of a liability for Exxon, so he was banished to Imperial. And he actually presided over a pretty decent turnaround of their Curl Lake asset, and so Exxon kind of has a bit of a playbook on how they deal with things like that. And if they're taking over an asset that has issues, the first thing that they're doing is they're sending in like their cowboys basically. some managers who can grab a hold of a project and turn it around. And so this is an anecdote, but knowing somebody who had worked at Imperial under Rich Kruger, they were having, serious issues with a turnaround that they were doing at Curl. And at one point, this guy's cell phone rings and he answers it, and it's Rich Kruger calling him, going, "What the hell is going on there? Like, why is this, taking so long?" Now, for those familiar with a place like Suncor, you could count that something like that would never, ever happen, and that you would never be held accountable for anything. So I think we're going to see a level of accountability for performance being brought into Suncor, which I think is a key change that needs to occur. After that, Exxon typically sends in safety people to sort out a poor safety track record. Now, this is sort of a rollout over time. But that's another thing that Suncor has really dropped the ball on, and there's reasons for that, and there's a lot of bureaucratic structural reasons within the company, as well as other things. Once again, I think if Rich Kruger's coming in and he's going to do the Exxon playbook, because that's what he spent his entire career doing. And so I think again, having gone from years of just wailing on Suncor and talking about how terrible they are, I think that over a period of time, having Rich Kruger as a leader has a really good chance of shifting the organization in a positive way. It's never going to be CNQ, it's never going to be some nimble, amazing, but I think that they can properly utilize the good assets that they do have and deal with the problems that they have with some different leadership. So that's my take on Suncor. It's cautiously bullish, we'll say.
I like it. Why don't you talk a little bit about the revitalization of the junior sector in Canada and what's going on there?
Yeah, absolutely. So, you go back over the last 10 to 15 years, and the name of the game for basically any oil company has been resource plays. So, for those unfamiliar, what is a resource play? A resource play is, shale. Shales, you basically have this vast resource that is a serious engineering nut to crack to get the oil out of it, but it's there, and you've got a huge amount of it. The oil sands are another resource play. Once again, it's there. It's just, it's a fight against technicals and engineering of how to get it out economically. And hydraulic fracturing and the oil sands, two separate things, really are both these massively capital intensive, large scale projects that it is impossible to compete as a junior. And I think that's what we've seen in Canada. And I think we're seeing it in the United States going forward here, that all the little guys in any of these resource plays are just getting scooped up by big players, and that's how we have CNQ in Canada that owns, the lion's share of the Montney along with Tourmaline, and slowly is aggregating up the oil sands. So there's no room for juniors in something like that. But what has come about in Canada, at least, and we'll see if it takes hold in the US as a concept, but we started drilling these wells called open hole multilateral wells. And, it's sort of shallow, conventional-ish oil exploration. And all of a sudden, everyone realized, or a bunch of people realized, oh my God, this is going to work in all these different places. It's kind of like hydraulic fracturing. They start out in the Barnett Shale, and then they go out and go, oh my God, I can frack this and I can frack that. And next thing you know, they're fracking everything. And the nature of these wells is they're quite low cost. And so a junior company, that doesn't have a 200 million in capitalization behind them, can actually start up, do some real geologic work and make a go of a new play. more and more we're seeing that. And it's those kind of technological shifts that I can see making a difference in, a material difference for the existence of junior oil and gas exploration. And it's pretty exciting. It's a really cool thing to see. It was, it's something that had to come at some point, and I think it's here. It's going to be exciting to see if it goes other places as well.
Exciting stuff going on in Canada. That's good. And we'll come back to Canada. We'll move over to the U.S. Talk to Jason for a little bit. Kind of wanted to talk about, well, first, U.S. production. I mean, according to EIA, the last 9/14 report, Feb production declined slightly from January production, like 400K. But, realistically, oil production has been pretty flat since October. So do you see the U.S. having any meaningful increases? I mean, there's lots of talk about a lot of potential for Permian to be higher, not so much for other basins. But EIA seems to think, we're going to new highs. What are your thoughts on that?
Is that me?
That is you, yes.
Awesome. I don't see it. I posted March permits that were approved in the state of Texas, and a big chunk of them are like Crane County and others that are not necessarily shale plays or horizontal San Andreas wells and stuff like that. So it's not a very big deal. It's like 300 to 400 barrels versus 1,000. And I think you see shale winding down right now. So I do not see. I don't know where the oil is coming from, but I don't think we'll get anywhere near 2019 levels of production, much less, last year's production. So I think you're seeing it winding down, and everybody's starting to acquire others to try to hold up their reservoir numbers or reserve numbers and production numbers through acquisitions now.
Yeah, and that was kind of my next question is, do you see more M&A in the U.S.? I mean, there's lots of talk about possible mergers. What do you think what do you see on the horizon of, possibilities on some mergers?
Yeah, I think for now you're going to continue to see American mergers and acquisitions, and then sooner or later Canada is going to be the hot topic, and you're going to see a lot of these shale companies move north of the border. And that's kind of not investment and bias, but I'm holding MEG Energy right now. I think they'll be a target within the next 6 months because there's nothing that touches them as far as acquisitions go in the States. So I think Canada will become more and more appealing as everybody realizes their meal tickets are running out here. So.
Don't they need more pipeline access, particularly to the West Coast, to get it to move it out of Canada? What do you? I mean, I guess this could be a question for Alex too. But what do you see on the horizon? I mean, the ideal would be to sell to China, right?
Yeah,
for Canada.
Well, I think there's challenges in Canada, but if you look at kind of the options out there, there's going to be challenges wherever they go, whether they go offshore, another country. I mean, it's because at the end of the day, the American shale, what you can do in shale, they're just running out of rock to drill, and if you're not drilling shale constantly, your production and reserves, for that matter, start tanking. So I think $100 oil kind of hid the fact for a lot of guys that they're in trouble. I think the labor shortage and the high prices kind of covered up for guys that couldn't necessarily drill good rock. And I think these lower price environments are going to kind of expose the weak ones, as Alex was saying earlier. And you're just going to start seeing acquisitions, and it's going to be a bloodbath, in my opinion.
So, do you have any thoughts on this WTI move or none?
I've held since last year we could see 60 because of the economy. Um, but anything over 60 for me, I'm more conventional. So anything over 60 is really good. And if it goes under 60, we've got bigger problems to face. But I think overall, it's not that concerning because I see every day that we're running out of production. So it may be a month, it may be 2 months, but I think we're going to start seeing oil crank up. So um, once the economy cleans up, I think we're going to see 100 plus oil again. So.
Well, the oil bulls on this stream will be happy to hear that. We'll go back to Abby for a little bit. So we're kind of in that buy zone, right, for the Biden administration for the SPR. You think that's going to happen?
No, I don't think so. I think we're we're still like in this period of selling from the SPR, and that's going to be winding down soonish. But we're still here. And again, I think I don't think the buying back is really going to happen in the near term. And I don't even think it's going to happen later this year, unless there's, again, there's, as he was just saying, like, there's like kind of a prolonged like $60 environment because the economy is just so terrible. But, I don't, yeah, so I don't really see that either. And just to add a few points on, what we were just talking about. Yeah, I think U.S. oil, does make a, barely a new high, compared to where it was pre-COVID, but I think it's really going to struggle, to get there. It's going to be kind of a grind, and it's already, showing signs of flatlining. And I definitely agree with some of the, the other comments around, issues around, acreage quality and, and what producers want to do. So, the supply kind of restraint question, is not just about OPEC. I think it's a domestic issue as well. I think you're going to see supply, really kind of struggle over the course of this year and into next year. So, I think that also does provide support to oil. I do think, yeah. I mean, I think again, back to your first question, I think, macro, could really kind of push oil down anywhere, right? But I think kind of the right band to think about is between 80 and 90 for where oil should settle out. I don't think we see 100 this year. We'll kind of see how next year looks, but I think 80 to 90 is kind of the right range for oil to settle out. But it may take a while to get there if the next month or two are really sloppy. Or you may, we've kind of been going back and forth between macro is bad, macro is okay. If the macro is actually okay this summer, and you do see some of this physical market tightening, then you should be back into that 80 plus range in short order. So I think we'll kind of see. I think it just kind of comes down to how bad the macro environment is, and you need kind of more of like a hard landing type, scenario to kind of really keep prices, in the 60 to 70 type range for a prolonged period. But I think the issue for the oil market is that, the hard landing scenario is quite real, right? And the possibility of that is not just kind of an immediate thing. It could be anytime in the second half. I think that's something that oil will struggle with, over the short term, and then certainly cap the upside, even if it does stabilize.
So, so at $60, it's still, and that's fine. Do you feel that's fine for, U.S. oil companies as well?
I don't think so, actually. I mean, I actually think, U.S. oil companies, right now TI is at 68, and I think U.S. oil companies want to see TI at like at least 70 to 75 to kind of maintain, kind of any semblance of a growth path. This is not including like, kind of the majors or the large companies, which can do with, with lower prices. So I think especially as you kind of get to like small, like medium and smaller producers, I think 70 75 is a preferred range for TI. And I think and we haven't talked much about gas. I mean, I think in gas we're pretty quickly starting to see the knock on effects of a price environment that is suboptimal for producers, and you're going to start to see it's going to take a while, but you're going to start to see that effect on supply. Maybe in the second half of the year and into next year, where you have pretty large year-over-year growth for gas right now, but I think that's going to shrink as you get get through the year. Similar to oil, I think if you kind of hang around in the 60s for or get close to 60 or below for for the next couple of months, couple of quarters, I think you will see a supply response.
Yeah, absolutely. Absolutely. And you guys, any of the speakers can jump in at any time. Feel free to comment on whoever's speaking at the time. Just wanted to put that out there. As far as, let's talk about U.S. LNG for a second. We've got a lot of export capacity building out. It looks like Freeport is, almost there, 100%, almost. So how do you think this factors into pricing going forward, or is there just still too much supply no matter what?
Was that for me, by the way?
Yes.
Certainly, LNG is ramping up. I think there is a decent amount of supply out there, but I think the export kind of volume dynamic is going to be pretty strong into the summer, and then later on this year. I think the arbs are still there. The economics make sense. I think people are sort of not really focusing enough on the lack of Europe obviously is in a pretty good place storage wise. Refilling is going a little slow, but the levels are strong. But for the second half of the year, or at least for this time last year, they were still importing Russian LNG or sorry, Russian gas. They're just not going to have that dynamic for the entire second half of the year. So I think maybe I don't think you'll see the type of prices that we saw last year, but you should certainly see a level that is pretty firm in the summer and into kind of the end of the year. And LNG export volumes are from the U.S. in my view are going to be maxed out. Apart from some maintenance and other kind of seasonal dips, like shoulder dips, are going to be running pretty close to full tilt. And so that plus the supply response, plus if you have kind of weather support this summer, I think gas prices should firm up. For now, there's just a lot of gas out there from an upstream supply standpoint. That'll just take a while to kind of work through the system. But LNG will certainly support that balance dynamic, I think.
Just to jump in on gas supply, I'm sort of a structural gas bear, and my reasoning for this is that if you throw a 50,000 or 100,000 ton frac onto a mountain of dog shit, you'll still get a 20 million a day gas well. So, it's too easy to bring the stuff on. And I mean, hell, we've got probably, I don't know, something like 500 TCF of gas in Northeast BC that we literally just forgot about because it's just sitting there, and you can bring on 30, 40, 50 million a day wells, and they're not the easiest drilling, but there's just a mountain of the resource, just so much. And all you got to do is frack it and out it comes. And so it's in an environment like that, with technical realities like that, it's hard to be long-term bullish on the price of nat gas. I mean, I think that I love the LNG story and that it's coming on and it's going to be good for everybody. But I would expect lots of volatility and not long-term high prices. That's just my 2 cents on the gas picture.
So pretty much like just like it's been, right? For the
I,
last
I, until we have evidence that we truly run out of rock that we can frack and get a lot of gas out of, yeah, I, I don't see it.
Cool. And then just one more question for Abby before he has to leave. I know you have to jump off. And this is not actually about North American oil and gas. So I just had a side question really fast because what's going on? Obviously, we have OPEC who's cutting and Russia who's not really cutting. And there's a lot of talk of, OPEC's just going to open the taps again and it'll be a 2020 all over again when they had a disagreement with Russia right before COVID lockdowns. Do you see this happening, or do you see do you see them talking to Russia, or do you see them cutting more, or do you see them completely turning on the taps again?
Yeah, no, good question. No, I don't. Yeah, I don't really see anything kind of close to a 2020 type of environment. OPEC Plus in general is pretty in sync and in tune. I would say the same about the Saudi Russian dynamic, and obviously kind of the steps that led to the surprise cut. I think given some of the sanction issues and challenges and other problems that Russia is facing, I think there will be a little bit of slack in what they do over the next 3 to 6 months. To your point, like they're not really cutting. They're definitely not cutting export volumes at all. Actually, they're increasing them.
Exactly.
They may be kind of modestly cutting production because of what's going on, with domestic refining and having to maybe peel back product exports to a small degree, but they're definitely not cutting oil exports, and that's not going to change anytime soon. But Russia may be slightly cutting, but OPEC plus the rest of OPEC kind of pulling more of the weight over the over the short term. But yeah, I mean from a group dynamic, I think they obviously are not going to be happy about the price dynamic, but I think we're also just at the at the start of the cuts, right? I think there is room for the physical market, back to your original question, to and fundamentals to really kind of help to support the market, even if the macro remains crappy and with a lot of stuff to still sort through. So I think they'll wait. I think they'll kind of give it the next month. They're going to be meeting again in June. Give it the next maybe even 2 months and just see what happens. If we were stuck at like $60 oil, then I would certainly pay attention. But I think I think the dynamic remains pretty firm and pretty strong. I think they're pretty in sync and on the same page, and especially the Saudi Russian dynamic.
Excellent. Thank you very much. Again, thank you for coming. I know that you had to leave. I really appreciate your time.
Thanks for having me.
Thank you. All right, let's go back to Alex. Let's talk about Canada a little bit more. Let's talk about what your thought, what do you think are the highest quality netback plays at this point in Canada?
So, I mean, it's pretty clear highest netback plays. The highest netback play is the Clearwater, and the Clearwater is this fairly broad major discovery that came about with open hole multilaterals, and it's grown from basically nothing in 2018 to close to 100,000 barrels a day collectively around the different Clearwater fields that have been discovered. And it is, it's not exactly conventional oil. Think of it as it's like conventional oil, but you can't hit it with a vertical. You have to do it with a horizontal. but it doesn't require any kind of stimulation. And so, for those unfamiliar, when you're drilling a horizontal well that you have to hydraulically fracture, a really good chunk of your well cost is in that big frac. Actually, it's the majority of the cost. In some cases, I've seen it where it might be 2/3. And so, with these kind of wells, you're just drilling these multiple laterals, and you just leave them open, and you turn it on, and oil comes out. It's actually pretty straightforward, which is a lot like conventional oil. And conventional oil, drilling, the old days of the gushers and whatever, just drilling verticals and putting a pump in there and turning it on. The economics of those wells, especially when they came on and there was some pressure and they had a decent initial production rate, the economics of those kind of wells are staggering compared to something that's a resource play. One of the things I actually wanted to kind of jump in for a second there earlier when we were talking about supply response and prices, something to consider is the strip price. Not that the strip price is necessarily predictive of the future, but if you're drilling, let's say you're drilling a shale oil well, and it's going to take 18 to 24 months to pay out that well, pay out the drilling and completion and tie-in costs, then in order to have some security of the capital allocation, you have to hedge your production for the period of time it takes to pay out. And so I remember hearing from some guys when WTI was around $80, and they basically were canceling their drilling program because unless they could hedge at $80 for 2 years, their wells didn't make sense. So for a well like that, maybe you need WTI at 100 to get the strip high enough to be able to hedge out the payout of your well. And so if you've got a well that pays out in 18 months, I mean, maybe it's a decent asset. Maybe it's a reasonable allocation of capital, especially if you have the potential for a large scale development and you can bring on a lot of these wells in a small area and share infrastructure, blah blah blah. But you have to hedge, and it's a pretty serious economic risk, because if you do that, you don't hedge, and the price cuts in half, those wells will never pay out. Like they'll literally never pay out, and your company will be bankrupt before they ever are paid out. So that's a serious risk. On the flip side, you look at these conventional-ish open hole multilateral plays, and if you're the top tier wells in those plays, you're counting your payouts in weeks. It's kind of staggering. In a lot of cases, on a 5-year timeline, you might have a well that pays out 5 to 8 times, which is incredible. Part of it's a feature of these low costs. Part of it's the lower decline rates. And so, I mean, these kind of wells are without a doubt the highest netback plays. It's also a feature of the royalty regime that we have in Alberta, which has sort of it's almost like a pre-payout, post-payout royalty system, but it's for every well. It's called C-Star. And because of the way it calculates the sort of C-Star credits, these open hole multilateral wells spend a lot of time royalty free or very, very low royalty, 5% royalties that maybe it's a little beyond where they should be, but I don't want to say that. But without a doubt, that's the highest netback play that you're going to hit onshore North America. There's some other plays that have geologic components, like the Charlie Lake oil play in northwestern Alberta has some of the highest netbacks around, but it's still not as good as the Clearwater. So speaking to that, some of the players in and around the Clearwater, it's kind of interesting. You can look at some of these different companies and their business models and the different multiples that they command. My favorite comparison is there's a 3-way comparison of Baytex, Tamarack Valley, and Headwater Exploration. And, so for those unfamiliar, Baytex actually had a really good discovery at a place called Peavine, and they brought on some of the most prolific wells in this entire play. But if you look at them as a whole company, this one discovery, as good as it might be, is only a drop in the pot compared to their broader asset profile, a lot of which is weighted towards the Eagle Ford in Texas. And so they're multiple when you look at, say, their production level
Abby,
versus
can
their
you mute
market cap.
yourself? We're getting
Abby,
feedback. Thanks. All right. Go ahead.
yeah, no, all good. So, they have this very diverse asset package, and some of it may not be so great. A lot of it is not these super high netback, low cost plays, and they're sort of, some might look at them and say they're all over the place. And I would say their multiple reflects that. And then, the next comparison is Tamarack Valley. And so Tamarack Valley, in my opinion, the way it looks to me is, if we got a cycle going on for a little while here, they're kind of coming out as the asset aggregator of the highest netback geologic risk plays in Alberta. So they're aggregating the Clearwater as best they can. They've made some big acquisitions, the biggest being Delta Stream, which was one of the sort of originators of the Clearwater at Martin Hills. They have some of the best acreage there, and so Tamarack Valley bought them, and they seem to be rolling up a lot of these smaller private players as well, and trying to take on probably the biggest of the Clearwater players, which is a company called Spur, which is private. So we'll leave Spur out of it because they're private, and that whole thing. But if you look at the multiple that Tamarack Valley commands, in spite of none of their exact assets being quite as good as Peavine, having quite the kind of rates, and being an asset aggregator, they still have a higher multiple than Baytex. And I think that speaks to the value of focusing on what you're good at and play concentration, and not just chasing after the next newest hottest thing, which I feel like Baytex has been guilty of throughout the past cycle. Going from what they know and what they're good at to chasing the Eagle Ford or chasing whatever. Surprised they didn't try and buy nat gas in Europe or something. And then the final comparison to look at is headwater exploration. And I love Headwater. I think they're a great company. They have a fantastic management team, and that's always a big consideration in the oil and gas industry. People think it's just assets, but I mean, you can have a great asset, and you give a complete idiot a great asset, and they can figure out a way to ruin a company with it. And so Neil Rozelle at Headwater has an amazing track record of performance and outsized shareholder returns. And so they ended up getting a bunch of assets spun out from Cenovus with a lot of room to run on exploration, and they've engaged in genuine exploration. I mean, they did a little bit of rank exploration, thinking they were going to nail an offset of Peavine, and they drilled some wells and ghosts came out. But you know what? No one really holds that against them. No one says, "Oh, Neil Rozelle sucks because they drilled some dusters." They genuinely went for it, and they have a good track record of exploration. And so if you look at they're entirely concentrated. Like, all they are doing is shallow Cretaceous sand oil plays with open hole multilaterals. And their multiple, if you look at their market cap versus Tamarack Valley, they have almost the market cap of Tamarack Valley with 1/4 the production. And I think that speaks to the value of quality. I get on here and I harp on quality a lot. If you're buying crappy companies, expect crappy results. This is not the time to try and pick up cigar stubs and smoke them. You want to buy good stuff, and you want to buy good management teams with a track record, or people who are engaged in the right kind of plays that can make these kind of really, really good returns. And yeah, so that's how I'm looking at it. So I think, looking into the future, you look for who seems to be allocating capital well, who seems to be focusing on what they know, and who's chasing after the kind of plays that are suitable for a company of a given size. Aggregating, Baytex going into the United States and trying to aggregate stuff in the Eagleford. I mean, with Canadian access to capital, I don't think you can play in that sandbox. I just don't think you can. I think you need, American-sized capital. And so, it's important to stick to what you know and what you're good at. So that's kind of my thoughts on all of that. Yeah. Thanks.
Awesome. Let's move to Jason for a little bit. So what do you think the best plays in the U.S. are right now? And kind of what areas are you looking at that, aside from the majors?
I don't see anything just jumping off the page at me. I think to Alex's point, I think you've got guys that have been faking it for a while, and they may have good rock, but they've just run it into the ground. So I think that those will be the biggest opportunities where you can take advantage of poor management. I'm doing a consulting gig right now, running an oil company that had very bad management, and high oil prices kind of hid the fact that they were really horrible. I think that's where the opportunities are right now. But as far as shale plays, unless they can figure out how to rework horizontal wells on a large scale, which is quite the engineering task, I don't see a big play that's just in the United States. I don't see anything that's the great final frontier right now. I think it's everybody's just trying to survive.
Well, that's a happy thought. There's a Bloomberg article out. I don't know. It said U.S. shale capital won't invest in itself. Midland's inability or refusal to fund basic infrastructure upgrades is dinging worker retention rates and imperiling Texas' ability to deliver the energy needed to fuel the economy. Is this true? And what's going on? What's going on there?
Yeah, well, it's more simple than that. I think a lot of bankers and private equity have learned how to actually do math on these shale wells, and they've realized that there's a fair way, and then there's everything else, and everything else is basically trash in these plays. You have the good wells, and then you have the crap, and I think bankers are learning that, and then it's kind of a double whammy where they're realizing what they can put money into, what they can't, but then you have the ESG stuff coming in over top of it, and also hurting the ability to get financing. I've seen more money in the last 3 months come in than I have in the last 2 years. So I think the ESG, everybody's saying screw the ESG stuff, and they're starting to come back. But it's hard to put big money to work in the United States right now. Like, you have to have a very good team to be able to knock that out.
If bankers learn math, then the oil patch is over.
Well, I was trying to be polite about them, but I think they're actually starting to get experts to actually look over, what if they're actually making money paying $10,000 an acre, and then a $15 million well, and it's fascinating that the change we've made in the last 10 years.
No, 100%. I personally, just opinion. I don't want to claim to be a total expert on all the U.S. Plays and all that, but I think you'll see, individual companies that outperform based on high quality management that can make good acquisitions in a concentrated area. I think Enerplus in the Bakken may be an example of that. They were actually a Canadian royalty trust, and they basically transitioned to being entirely a Bakken company. But it seems like they've made some really good acquisitions as well as divestitures, and have sewed up, some of the last remaining high quality undeveloped acreage in the Bakken. And they'll probably build additional value for shareholders, I think, before they're ultimately acquired by, whether it's Continental or whatever. I think you'll see examples like that where good management teams can identify value and execute on it effectively. But it's not like they're going to discover the next Bakken and 100x equity. It's just not going to happen. That's not available in that environment.
I'm surprised with rising rates. We're seeing money come into this sector. You would think it would be harder to fund, well, or more expensive, right?
Well, it is and will be more expensive, but the question is, can you actually get a return on your money? So, I mean, if you have free money forever and interest rates are 0%, well, then you can pile it into a $80 billion app that, I don't know, tells you where to get a colonic or something. Like, I don't know. You can fund non-productive investments at zero interest rates, and it doesn't matter. But if all of a sudden the interest rates exist, then you need a return. And even if the return you may get from an oil and gas investment is not fantastic, as most of them aren't. Some of them are, niche stuff, you can get a fantastic return, but most of it's not. But it may present a return, which is more than we can say for much of the tech sector and all that kind of stuff.
Yeah, but that's a very good point. Very good point. And I mean, oil and gas isn't going away anytime soon, even though our overlords would like to think that it is, right? Or they're telling us to get rid of it. So
yeah, well, absolutely. I mean, the reality is, and other people say it, energy is life. The food you eat every day is a product of the Haber process, which is natural gas turned into fertilizer. Without diesel fuel, our lives suck so much that it's unimaginable. So yeah, I mean, oil and gas is not going anywhere. And could we use it more efficiently? Of course we could. Is there policies that stand in the way of doing that? Yeah. But ultimately, energy's life, and so we're either going to use it or we're going to have a real bad time.
oh, absolutely, you're preaching to the choir. So, what do you think about? You mentioned fertilizer. Do you think we're going to have the same problem that we did, say, last year with fertilizer prices?
So okay, I want to qualify this. I don't like to make pronouncements about what's going to
Okay.
happen with prices because prices are a fickle thing. Everyone freaks out and the price of oil goes up $30 a barrel in a 2-week period in March of 2020 because everyone got scared. So the prices are they're a short-term signal that has a lot to do with sentiment.
Okay, let me rephrase that. Let me say, how about a supply problem?
I think long term that we do have a supply problem with fertilizer. And the thing with fertilizer is it's such a long cycle product. I mean, you basically have a full year production and application cycle. So, we're all sitting here looking at prices moving on an hour by hour basis. Well, some of us are, I don't. But, looking at these short term moves, these, okay, well, there a cargo just sold for this, and oh, there's cargo here. What, we're looking at these very short term, small things. And we ignore the bigger things that happen on a longer time scale than we like to operate in. So looking at fertilizer, look at Europe. I don't follow this on a moment by moment basis, but as far as I can tell, there's still millions and millions of tons of nitrogen fertilizer capacity shut in Europe that was shut in due to gas prices. And I would say without the return of Russian natural gas is unlikely to come back online because, Europe basically sacrificed its industrial base to reduce natural gas prices for consumers. And so the timeline on this cycle is long, and we're not used to working in long time cycles. So I think we have an ongoing fertilizer production, which will then roll into agricultural productivity problem. So long run, I would say that prices will have to reflect this, unless, of course, and hey, I've been wrong before. I've called time of death on U.S. shale and just had my face ripped off, so I'm not always right. But unless we were just making and using way too much nitrogen fertilizer, which maybe we were, but I don't know. That seems implausible. So I think long cycle, we're in a serious problem, and we're going to need to innovate. Now, thankfully, for the fertilizer and agriculture sector, innovation is super. It just hasn't really happened. There hasn't been much innovation. I mean, we're still like nitrogen fertilizer is basically the same as it was 50 years ago. And yes, there's been precision application stuff that's changed, all of that, but there hasn't been big sweeping innovations like we see in other industries. And farmers tend to be stuck in their ways and don't want to try new stuff. So this may force a new wave of innovation, which, takes the agriculture sector a little more into the future. And we're not all going to die, but I do think that there's long cycle issues that we're facing that we thought went away because prices went up and then went back down. And it's like, oh, everything's fine. No, everything's not fine. How that plays out, we'll see. But I can say, if food prices go up on a sustained basis, keep going up, stay up, inflation is not going away, because the one thing that you cannot avoid, the one thing that you will sell everything to do is feed your family. And that's a whole thing. It's going to be interesting.
Absolutely. Well, we're coming up on the hour here, so I want to thank you guys. We do the last round. The last round is kind of just mention something that we haven't talked about that you wanted to talk about, or, what should we be looking at, over the next couple years? Jason, one of you go first.
I think Mexico is about to implode, as if their production wasn't already bad enough. They're buying scrap tubing, production pipe out of the Permian right now, and just trying to patch it right now. So I think they are very, very broke, and I think they're broker than anybody can imagine. So I think there should be some fireworks out of Mexico shortly. If the tubing, after a while, you get holes, things like that. So basically, what they're coming out to the Permian and buying trailer loads of this scrap tubing that is useless for outside of fencing, and then they've got some guy trying to weld patches on it. So that's the state of Pemex right now. And I think that's just another example of a lot of guys have kind of faked it for the last year, and now we're about to see who's smart and who's stupid, and bloodbath potentially. So
I'm glad you mentioned that, because I forgot to. I was going to say we should hit on Pemex a little bit to see what's going to happen. I guess good news for the U.S. They'll just import more nat gas from us, right? But bad news for Pemex. And then your final thoughts, Alex.
Yeah. The one thing I didn't talk about, and I think is worth talking about if we're talking North American oil and gas, is the impact of the Canadian exchange rate. And it's something that some people are not aware of. I think we're pretty aware of it in Canada, but if I can't remember what we're at today, who knows? Let's say we're 75 cents US. When WTI is at $80, that means we're at 105. And so even with, oil in this range of, let's say we're sitting range bound between 70 and 90 for the next year, in Canada, that's 90 to 100 and 105, 110, whatever. And, we're paying service costs in Canadian dollars, but we're selling in US dollars. So we're getting this big uplift from the currency. And I do not see the Canadian dollar strengthening meaningfully until a lot of things change in Canada. And I don't see a lot of things changing in Canada very quickly. So that's something to look for. And then, of course, just briefly, Trans Mountain Pipeline and the expansion of egress from Canada. Trans Mountain, in spite of many people's misgivings and the incredibly slow and inefficient pace and capital inefficiency, I believe will get done. And when Trans Mountain is done, Canada is structurally overpiped. Like we will have more egress capacity than we can fill. And I think we'll have that for years, because I don't see, there's not going to be new oil sands mines. There'll be pad adds and little debottlenecks and whatever, but there's not going to be chunky production coming online out of Canada. And so we're going into this structurally different regime than we've been in, which has been consistently egress constrained for almost a decade. And that's going to change. And, I think it changes the diffs that we see on WCS. It changes a lot of things. And I don't think it's something that anybody here knows what to do with. So those are my final thoughts of things to think about. And yeah.
That's awesome. Thank you. And thank you both for coming up today and taking time out of your busy day. I really do appreciate it. Everybody follow these guys. They post great stuff all the time and some fun stuff too. And follow Place Your Trades to see what other events that we have coming up. And I will see everyone next Wednesday. Have a good day,
Thank
everyone.
you so much. Thank you so much.
Thanks for having me.